Hello and welcome to Market Domination. I'm Josh Lipton, live from our New York headquarters. It's just an hour to go now until the closing bell, and stocks, they are falling as investors digest the flood of earnings, and there's a big rotation out of tech. But first, we're diving into the latest in Disney's long-awaited succession plan. Disney making it official. Company naming Josh D'Amaro, its next CEO, taking over for Bob Iger later this year. D'Amaro oversees the parks and cruises business, which has been a key profit driver for the entertainment giant. Joining me now, got Matt Dogan, Morningstar Senior Equity Analyst. Matt, it is great to see you. So let's just start with Josh D'Amaro, Matt. I mean, you know this company backwards and forwards. So what did you think? Do you think Josh is the right guy? He's got the right resume, background, experience, Matt. This is a good fit?
Yeah, well, thanks for having me, Josh. We do think that this is the right pick. It was pretty widely reported that Dana Walden and Josh D'Amaro were the frontrunners for this role. We think each of them had qualities they brought that actually the other didn't, and either would have been fine choices. But we do think D'Amaro was the better choice for really one simple reason, and that is experiences, which is where Josh D'Amaro has his experience, is the most important part of Disney. It drives most of the profit, closing in on 60% each year. And it's a growth business as opposed to entertainment in general, which is shrinking. And if Disney needs to rely on entertainment, it's in bigger trouble. Relying on experiences is where Disney is especially healthy. And not that they aren't both important, but with experiences being especially critical, if you had to pick one, which, by the way, we do think one was the way to go as opposed to co-CEOs, Josh D'Amaro was the choice in our view.
There's some pushback I've heard, Matt. I wouldn't even call it pushback. I would just call it a point some folks are making is they'll say this. I'd love to get your take. They'll say, listen, Disney, they'll say, is first and foremost, it's a content company. It's all starts with that very valuable, sought after IP. And they'll say D'Amaro, you know, he's an operator. He's a parks guy. What do you make of that? Is there any kind of tension there?
I don't know if tension is the word. It is really the exact reason why I said each of the candidates brought something that the other didn't, because you're right. That's what Josh D'Amaro lacks a little bit. As far as Disney being a content company first and foremost, yes, the content starts everything, but Disney has a lot of that already established, and not that it doesn't need more, and not that the other part of the business isn't important. And that's why neither of these candidates had maybe the entire package that one might want. And I don't think anyone does for a company like this. But Experiences is set up to grow with a lot established in place already. And that has to go right for Disney's stock to be successful. And again, don't get me wrong, streaming, especially as traditional television continues its transition, is extremely important. But the profits come from experiences. Disney does already have a lot of IP established franchises that give it a good base, and continuing on the growth trajectory with what already Disney has in place with experiences is the most important thing for this company. And by the way, that's also why we thought it was really important that Dana Walden is staying on. She got a little bit, bump in her title, a nice pay package, and she's staying. And it's really important for her to have her there because both of these businesses are important. But we thought choosing one was the best, and either was going to have pros and cons.
And it looks like, Matt, D'Amaro takes over in March. So coming up fairly quickly, is that sort of the rough timeline you imagined?
We had been thinking it was probably going to be later in the year. Bob Iger's contract goes through December 31st. In recent weeks, it was reported that he'd probably leave earlier than that. We knew that this announcement was coming. I didn't think it would happen this quickly. Seems like by the next earnings call, by the next earnings call, we will have a new CEO. So that's not what I was expecting. But it did seem like they weren't going to wait till the end of the year. And it's been so long awaited, well established that the transition was coming this year. It's not something that really strikes me as something to put too much thought into it. It'll be nice to just have it finished.
Matt, how much confidence do you have that this transition, this handoff, that it does go smoothly, Matt? It does go as planned? Because as we know, of course, there's been issues in the past with Disney and succession. Do you think this time is different? And if so, how come, Matt?
Well, for one thing, this was it appears to be a much, much more deliberate, thought out process as far as who would take this helm and the candidates that were considered going into it. As far as whether it will go smoothly, our expectation is yes, it will. And we think having the established people in place and leading the respective areas they do, again, with Dana Walden continuing to play such a prominent role on the creative and in the entertainment side of the house, should help. But there is always risk with the transition. Being that these are internal candidates familiar with Disney, with DeMauro being so experienced and so critical to the success that Experiences has, which again is the top thing that we're looking for when we're looking for how this company performs each quarter and each year, it is something that I think should go smoothly.
If you look at the stock, I mean, it's been largely basically range bound over the past decade, really. I mean, there's 2 periods of outperformance there. What are the key areas of opportunity here now for DeMauro, Matt? What do you think he focuses on?
Well, the way we're looking at it is Experiences needs to continue growing while keeping margins high, but streaming also needs to be an area where you continue to get the high growth and continue to increase profitability. So they've been doing that. As far as why Disney's been so bad as a stock performer over the past decade, really, we've been in the midst of the decline of traditional pay television, and Disney has been hit by that and this transition into streaming, which for a long time wasn't profitable. Disney has performed actually much better than a lot of its peers in traditional media, but it hasn't been immune, and it's been getting past that. The nice thing for Disney, and unfortunately they now are stopped reporting this with detail, but linear networks on the entertainment side have gotten to the point where they're almost inconsequential to the overall results. And so that's a business that we know is going down to about nothing eventually. But Disney's largely past how much that's going to hurt, which is why the detriment from having that business isn't going to be as noticeable anymore. It is a reason, though, why streaming needs to succeed. And then sports still has, the sports segment, largely ESPN, still has a lot of exposure to traditional linear television. And that business we're not looking to grow necessarily, but it does need to stay stable. And it's been doing that, and it is a key for the company. But that's an area that for the industry is not an area of growth that Disney still has a lot of exposure to. But with the composition of its business being more growth oriented, we feel pretty comfortable that Disney is undervalued here. And it's not to say that the near term won't face some headwinds, largely from headlines or from maybe macro events. Yesterday, they were talking about how in the U.S., they've actually seen a little bit of a dip in tourism to domestic parks. And so short term, that type of thing is a headwind, and it's something that we've contemplated and is in our valuation. But over the long term, these are healthy growth businesses with a lot of those more dying businesses becoming much less part of this company. So we think the outlook should be a little bit more optimistic.
Matt, as always, so good to have you on the show. Thank you.
Thank you.
Well, PepsiCo affirms its fiscal 2026 financial outlook as it dials in on delivering more value to consumers. Let's get to Yahoo Finance's executive editor, Brian Sozzi, who is joined by the company's CEO for more on the quarter. Sozzi.
All right, thanks so much, Josh. Ramon, good to see you here. In digesting this quarter, I think at the core of what PepsiCo is trying to do is make things more affordable for consumers. Now, all I hear about is the economy is doing well, but take us inside that core PepsiCo shopper. When they're out there buying beverages and snacks, how challenged are they right now?
Good. Hi, Brian. Thanks for hosting me today. We're trying to do much more than just affordability. I think we're trying to do a holistic investment in the business, with affordability being one, but also we're innovating. We're trying to give consumers more choices in functional and higher density foods. We're trying to give them more functional beverages, and we're trying to execute better. But to the point on the consumer, we're seeing still the consumer, if you think about the middle, lower income consumer, quite stable, same as last quarter, but still very stretched in their budgets, trying to be choiceful and cautious on how they spend their money, especially discretionary categories. And we're trying to help consumers to stay in our categories, in our brands. And so we'll make surgical investments. We'll help consumers. Certain consumers will have help them with certain packs, certain brands, to be able to afford us at the beginning of the month, at the end of the month, And with that, we'll grow the category and we'll grow our brands.
So Ramon, if I'm walking down, let's say Walmart aisle, of course a key output for you, you work close with Walmart, walk down that Walmart aisle at the end of the month, how much cheaper will Doritos be for me? And is that, those price adjustments, is that in your guidance this year?
Obviously, our guidance reflects this. We've been testing these investments for over 6 months in multiple markets across the U.S., and we've seen the return on the decision. Will depend the amount of savings that the consumer will have versus the current product. It will depend. In some brands, nothing. In some brands, meaningful investments to make sure that we get elasticity right. We get the consumer back into our brands. It is one of the largest or the most important friction points in the category. When we talk to consumers, they're telling us, would buy more of your products only if they were more affordable. So that's the key. That's the key insight. They're also telling us would buy more if they had no artificials. That's why we launched Naked, and we're seeing that there's consumers that were sitting at the fence of the category. They're coming in, moms that they're saying, now I can give my favorites to my children because you have no artificial. So we're trying to play in multiple directions, Brian. I think I see in the numbers that this will be successful investments for us, that our foods business in North America will continue the positive trend that we've seen in the last few quarters and that we saw in December and we're seeing in January as well.
You brought this up on the earnings call, and you seem to be tackling these GLP-1 issues. You and I have talked about this in the past before, but this is really the first quarter that you hopped on this earnings call. So this is how we're addressing GLP-1s. Take us through where you are testing this, and does it go beyond just putting out more single-serve packs and portion control?
Yeah, it is the way we're thinking about this is we assume that consumers will sequentially adopt more GLP medication in their lives, and either for real medical reasons or lifestyle reasons. And obviously this creates an opportunity for us, but it could be also a threat if we don't react. So we're leaning into action. We're leaning into, as you said, portion control for parts of the portfolio. We see that consumers are continue to engage in our categories, but in a smaller portions. They don't want to eat too much. They want their favorites at smaller portion. That is a key strategic bet for us. Multi-packs, assortment, and getting the right price point. Now, there are many more things, right? There is hydration, and I talk about hydration. Consumers need functional hydration. They want to drink more. Their body needs more liquids. I think we have tremendous platforms like Gatorade and Propel, and we're leaning into those platforms to provide even more bespoke solutions for GLP consumers. We know that consumers want more fiber because of the digestive, not problems, but they need more help with digestion. So we're providing whole grains. We're providing more fiber, not only in our food business, but also in our beverage business. We're leaning in with prebiotics, obviously, as you put there, with Pepsi prebiotics and Poppi. So we're providing holistic solutions. Protein being one clear category where there's an increase in consumption, and we're also providing, with the relaunch of Muscle Milk, but also in the snack business with Quaker, we're providing more higher protein solutions. So it is a holistic response. We're approaching it as an opportunity for the company, but also with a sense of urgency that we need to adapt the portfolio to capture this opportunity ahead of other competitors that will also be leaning into those same spaces. So
you have these new products. You're redesigning your supply chain, Ramon. You're looking for productivity. I see the new packaging behind you. I'm an avid snacker myself. I know that packaging is different. Would you characterize this year as PepsiCo undergoing really one of the biggest reinventions of the past decade?
Yeah, Brian, we've been working on this for already some time, right? This is part of our 2030 strategy. We know we need to transform ourselves. The portfolio of today will not be the portfolio of the future. The way we serve our customers today will not be the way we serve them in the future. The way we use technology today will not be the way that we can do things. We really adopt technology. So these are all investments and strategies we've been working on for the last few years. Now we're seeing the output of those strategies and the work of a lot of our colleagues that have been really working very hard to innovate, working hard to rethink the supply chain, working hard to create the data platforms and the data use cases that now we can scale across the company and become much more intelligent, much more flexible, much more agile company, and give our associates the opportunity to make better decisions all the time with real-time information, much more granular information that I think will help us make better decisions, be a better company. So yes, it is a transformation in multi-vectors. It's a transformation we've been working on. It's a transformation that we'll be seeing the results this year, but it's not only this year, it's 26, 27, 28. We're getting ready for a multi-decade of growth at the company. And we're running this company for the long term. We've always been doing that, and I think we'll see the benefits. And we see it, our investors really kind of recognizing the work we're doing and buying our stock.
Ramon, one thing that was not on my bingo card was to see a Super Bowl ad from PepsiCo with a Coca-Cola, White Baronet, and dare I say, even a Coca-Cola. Now, I have not seen this from PepsiCo in a while. Why are you're taking the fight right to Coca-Cola. Why did you think you needed to pull this ad? I can't even believe I'm watching this right now on the screen, Ramon.
Yeah, good. Listen, there are two things we're trying to tell consumers on the day of Super Bowl. One is we've tested our Pepsi Zero with over 100,000 consumers in the Pepsi Challenge, and Pepsi Zero, it has superior taste. Now, we say it in a fun way, in a way that it creates news for the category, and I'm sure it will create consumer awareness and consumer behavior change. The second thing we're telling consumers on the day of Super Bowl is Lay's has been growing potatoes for almost 100 years with U.S. farmers across the country. So we're celebrating our farmers. They're critical for our food. But then we're also telling consumers Lay's are the freshest potatoes. They can be from the farm to your table in 72 hours. I'm guaranteeing that. So those are two big insights. We want to be intentional, strategically intentional with our advertising. We want to create consumer new behaviors. And we're going to do it with fun. We're a fun category, so obviously we're going to do it with fun, engaging consumers, and this is what we're about. We've been doing this for over 100 years. We'll continue to do it, and our marketing teams are getting better every year. I loved you just explained that ad to me. You did not mention Coca-Cola, Ramon. I knew it was going to happen. I knew. Enjoy the big game. I will tell you, I will be there with my Sabra hummus. Ramon, enjoy the big game. I'll talk to you soon, man. Nice to talk to you, Brian. Thank you very much. Appreciate it. All right. Ciao, ciao. Josh, back to you.
All right. Thank you, Sasi. Coming up, we're tracking the market action heading into the closing bell. Some of the biggest moves we're watching are in crypto. Bitcoin breaking below $75,000. What's behind that move? That's next. Stocks are retreating from Monday's gains in a volatile start to February. Here with more on the market action, we got Jared Blickman. Jared.
Thank you. We're going to take a look at crypto and gold and silver, a couple of commodities as well. Here's Bitcoin. You can see the current price well below 75,000 at the lows of the day. In fact, it hit 73,000 and change right there, just popped above 75,000. We'll get to a chart in a second. Just want to show you real quickly what gold is doing. It touched, I believe, the high was 5,018, so punched right back above 5,000. It's still up 6.5%. Huge swings that we're seeing here. And I think the volatility that we're seeing since last Friday is almost unprecedented in the metals market. There's silver up 10% as well to 84.75. Let's not forget it was triple digits just a few days ago. But let's go to our crypto heat map and we can see this is a lot of red here. Bitcoin is actually doing better than a lot of these, down 4%. Ethereum down 5%. Solana down 5% as well. And let's check out the chart on Bitcoin because I've been making a big deal. I'm going to show you the 3-year about the $75,000 level. That has been my line in the sand. And to be sure, it hasn't really cracked yet. If we saw a plunge below 70,000, well, that would get me a little bit more concerned. But what I don't like about the last few days price action is that we came down, we had a low yesterday, and then we kind of used 79, 80,000 as resistance, and then we made a new low here. So that's not what I wanted to see. I wanted to see a nice quick rise above 80,000. That would give me a lot of confidence in the bullish case. We start spending a lot of time below 75,000. My thesis is that could be a crypto winter scenario. But let me just show you the year to date real quickly on these crypto tokens, and I'm going to sort by performance. Actually, let me put it back to a market cap view. Bitcoin down 50%, Ethereum down 26%, Solana 22, Doge 16. So you kind of get the picture there. Now here's the futures view. So look at that, silver in the upper left. Despite all the volatility and sell-off recently, still up 20%, gold up 15%. But let me bring it back to what we're seeing today. We've just seen a lot of volatile action, and I'm going to show you the 10-day in silver, and there we go. We got that $120 top, the big sell-off here, and we're just trying to make some sense of what's happening. Suffice to say, if you're in these markets, a lot of caution is warranted, and I'll send it back to you on that, Josh.
All right, Jared. Thank you. Well, Walmart joins the $1 trillion club as the retailer's market cap passes the $1 trillion milestone. We're looking at how it got here with Yahoo Finance's Brooke DiPalma. Brooke, walk us through it.
Well, certainly a momentous moment for Walmart, especially as new CEO John Furner takes the helm effective earlier this week. And now he's stepping into some pretty big opportunity. The company now surpassing that $1 trillion valuation. And just for some context here, Amazon, their current market cap is $2.56 trillion, whereas it's way ahead of Target, another big box retailer, which currently has a market cap of $48 billion. And so Walmart crossing its $1 trillion market cap, quite significant for the company, but it wasn't always supposed to go this way. Certainly former CEO Doug McMillon really worked over the past decade, over the past really 12 years under his helm to create once was just a physical store footprint, really move it into the future with e-commerce now a huge component for the company, and that really boosted same-store sales growth. If you take a look over the past decade, what we've seen is low to mid to even high single-digit same-store sales growth consecutively for the big box retailer. And what has really gotten it there is faster delivery times. The company now says that it could reach roughly 93 to 95% of U.S. households, ultimately competing with Amazon there. And also, Josh, that low price point model continues to win for the company, especially in this K-shaped economy. We've seen an influx of high-income consumers turn to Walmart, especially post-pandemic.
So let's say I'm a viewer, I'm in Walmart right now, I'm invested. What's next for Walmart? What's on my radar?
Well, certainly it'll be interesting to see how exactly Walmart plans to compete, plans to ramp up, really tech focus as it competes with Amazon. In December, the company relisted to the NASDAQ, so it currently is trading on the NASDAQ. And what we know is that Walmart is really looking at tech and AI, even drone delivery, as the next wave of the future to get in front of consumers so that they choose to shop at Walmart effectively over Amazon. And that will really be a key component here. How exactly is Walmart gearing up and currently competing with the e-commerce giant, and how will they take this into the future to really make sure that their marketplace really ramps up and meets the current demand that consumers have for both delivery, convenience, and also fastness. They just want their doorstep right as soon as they get home from work.
All right, thank you, Brooke. Appreciate it. Coming up, Congress breaks a stalemate over the shutdown. We've got the latest out of Washington. The House passing a funding deal and bringing the government shutdown closer to an end. For more, we're bringing in now Yahoo Finance Washington correspondent Ben Worschel. Ben.
Yeah, Josh. So the last hurdle before President Trump's signature to averting this ongoing partial government shutdown has now been cleared as the House of Representatives approved this spending measure in a vote of 217 to 214. This was a sort of more narrow final vote than people expected, but the end result here is the same. It's headed to President Trump's desk for his signature, where the White House reaffirmed again this afternoon that they're going to sign it as soon as they can. One outstanding piece of business here is the Department of Homeland Security funding there is only secured for 10 days till February 13th. That's because of Democratic concerns there, and it's going to be a sprint between lawmakers to kind of work out issues there over Trump's immigration efforts. But the bottom line, sort of especially for markets, is that 5 spending measures, most of which are in focus for markets, the Internal Revenue Service, the Federal Aviation Administration, places like that, now are set to have their funding secured through the fall, through September 30th, once President Trump affixes his signature there. One economic ripple has been economic data. We've already seen some delays there, but it's a far cry from the 43-day government shutdown we saw last year that had much wider ranging implications.
One thing before I let you go, Ben. So that economic data you mentioned that got delayed, what's the latest there, Ben? What do we know?
Yeah, so we've had 2 delays in evidence, at least so far this week. The jobs opening and labor turnover survey, i.e. JOLTS, that was scheduled to be released today. That obviously didn't happen. And we've already gotten word that Friday's jobs report will be delayed as well. This isn't an issue necessarily with the data itself. That has already been gathered. It's data for last month. It's a matter of just having people in the office to prepare it and release it. In terms of when it's going to be rescheduled, we just don't know that yet. I was reaching out to folks at the Bureau of Labor Statistics and at the Labor Department today. Mostly was getting bounce back emails because, of course, the officials there are furloughed for today. But all signs are that they'll be back in the office tomorrow, where they'll be able to sort of reschedule these releases for the coming days. Again, not changing the data itself, but just getting what needs to be done to get it out the door, either at the end of this week or early next week.
Ben, thank you. Appreciate it.
Sure.
Pfizer is defending its long-term growth strategy as investors zero in on obesity drugs and what's in the pipeline. Yahoo Finance's Julie Hyman sat down with the Pfizer CEO to talk about all of this and the company's earnings report. This breakdown is brought to you by EY.
Convenience is very important, but I don't think that the efficacy of the product will be lesser than other products. Keep in mind that what we saw, it is the low and moderate dose, the middle dose. This is compared to the highest dose of other companies. The highest dose of us, which is the 9.6 milligrams, is going to be tested now in the phase 3, and already we started testing it in our weekly study, but it is ongoing, as 2.4 milligrams per week, so times 4, 9.6. So this, I think, will exceed, according to our modeling, which we presented today in our presentation, very accurate modeling that predicts that the weight loss at week 28 of the high dose will be higher than anybody else's.
At the same time, it's still a little ways away from coming to market. I believe 2028 is what you all are targeting?
Yes.
So you have that, you have the oral medication you acquired through a Chinese company that I believe is in phase 1 trials. So how do you think about these obesity products sort of addressing the mid to longer term growth needs of the company, since it's going to be a while till they come to market?
The obesity market, I think, just started opening, and we are now almost at the end of the beginning. There is significant still unmet medical need, despite the fact that the GLP-1 medicines have been extremely well received. Still, there are side effects. Keep in mind that 40-50% of people discontinue after a year. Actually, in elderly population, above 65, that number is much higher. And also, there is the muscle loss. So there are a lot of solutions, I think, that will come that will bring better tolerability, more convenience, and I think that's what we are aiming to do. The more convenience is very obvious because all our medicines are based on a peptide platform that will be a monthly platform. I'm not talking only about the GLP-1 that you just saw, but also the amylin that is coming following that will be combined, the two, as a monthly product, hopefully. But also there is another one, GLP-1, that we are testing, which is 3 months, every 3 months. So we will resolve that issue. Then the combination progress will resolve the issue of the tolerability. The amylin and GLP-1, hope that will have very, very high, much better efficacy, synergistic efficacy than the two of them alone, and with good tolerability profile. And more importantly, the addition of the GIPR, which is another molecule that we have, small and large, will reduce significant the increase significant the tolerability will reduce the side effects. So we have a very complete portfolio of injectables monthly, maybe every 3 months, amylin and peptides. We have oral peptides, amylin and GLP-1, and we have small molecules, GLP-1 and GIPR. So with that highly differentiated portfolio and with the Pfizer muscle behind it, we aim to play a leading role once we introduce our product into the market.
So that gives you the confidence that you will be able to compete with the products that are already on the market and will have been on the market for quite a while by the time you all come to market.
This is exactly what I said. I'm very cognizant that I'm talking about two wonderful companies that are very good. They have good pipelines and they are ahead of us. But we are Pfizer. And we have shown to the world what we can do. And this portfolio is highly differentiated. So I think we are all in and we plan to lead that sector.
Obviously, the market is very interested. Some would say fixated on the obesity market right now. It is obviously a big market, but you guys have a lot of other drugs in the pipeline. It's not just obesity. And I'm curious where else you see the biggest opportunities that you would want to highlight to investors.
Clearly, in oncology, the acquisition of Seagen was transformational for us. And we have right now not only the current products in the market that we have released new data and to expect to grow significantly, but also we are running studies, phase 3 studies that will start reading out this year. The most impactful of the new generation of products, which is the SV that goes against lung cancer, is now tested and we will release data in second line plus as monotherapy, and then next year we will release data in first line lung cancer, which is much bigger population, in combination with Pembro. So oncology, I think, is clearly the crown jewel that is delivering and will continue delivering. In oncology, we have in the breast cancer the leading product, but also we are coming now with the CDK4 and CAT6 that will create a life cycle continuation. In prostate cancer, but again, we are the leaders with Xtandi. We are coming with a new generation that enhances the efficacy of Xtandi, and that comes again this year, the results. And so the pipeline, I'm very, very confident, and also this year is where we have the catalysts. But also I want to emphasize, if you don't mind, the performance. The quarter was stellar. In this quarter, we had the lowest ever COVID season. The reason for that is that the strain that is circulating right now, the dominant strain, is antigenically very similar to what was last year. As a result, this year we have very mild symptoms of the COVID. So as a result, we have very low COVID sales. Despite that, we significantly exceeded the sales expectation and the EPS expectations because we did so well with everything else. Our non-COVID business grew 9% this year. And if you take into consideration the new products, they grew 14%. So I'm very, very confident that this year this portfolio will perform extremely well.
Let's talk about that portfolio as well going into the future, because investors are always looking ahead. As you mentioned, your legacy products performed very well last quarter and last year. But when we talk about Eliquis, it loses exclusivity in 2028. So does Vyndaqel. So we're talking about together about $10 billion or so in revenue. As you talked about that pipeline. So do the math for me on how, you've got that loss of exclusivity, how the new products that are coming will make up for that loss of exclusivity.
Of course, I will do it immediately. Keep in mind that the new products, this year they had $10 billion of revenues, growing 14%. And that enters into next year, and I hope we will achieve same, and actually I hope we will achieve even higher dose. So they are growing as the LOEs are coming, the loss of exclusivities are coming. And of course, we are going to add the pipeline. So despite the fact that we are going to lose $1.5 billion this year, we think we gave a guidance that pretty much we will be very close to flat. Actually, we are growing if you exclude that we reduce COVID, right? So COVID we took down from 6.5 to 5 billions, and we increased 1.5 billions everything else. So I think it is going to do well. Then the next year, the new products will have a much better contribution because, of course, their base is growing and will overcome partially at least the LOEs of 4.5 billions. And then post-28, we are going to enter into a period of industry-leading growth because of this base that remains and keep growing. We are adding new pipeline, and we don't have any products to lose exclusivity. The LOEs are one-time event. Goes down and then helps you demonstrate very strong growth.
And finally, as we talk about investment to replace some of those LOEs, how are you thinking about balancing investment in research and development with business development or other acquisitions maybe, and then also focusing on paying the dividend, which I know you guys are committed to doing?
Yes, in preparation of this period that we knew that is coming a long time ago, we invested significant amounts of capital, $80 billion we invested in acquisitions. The vast majority of the acquisitions that we did, just to overcome this LOE period, it is in three companies. It is one, it is the Seagen, the second is Metsera now, and the third, it is the Nurtec acquisition, the Biohaven, that we got into migraine. All three of them are doing extremely well. Sales of the first and the third, and Metsera pipeline progression. And I think that we were ready for it, and we did it. Now, going forward, clearly we still have firepower to do acquisitions or licensing, and we are going to use it strategically. Our dividend, we guarantee that we will maintain the dividend. We said multiple times that we don't have any plans right now to reduce the dividend. And we will continue investing in R&D. As you see, everything in our guidance goes down except R&D. R&D, we keep it at $11 billion approximately, and we keep creating, with the use of AI, significant efficiencies. So everything that we are saving in cost, in R&D and productivity, we reinvest in new products. And that's what investors should expect going forward.
Albert, thank you so much for taking time. I know it's a busy day for you. Appreciate it.
I always, I'm here for you, Julie. Thank you.
I appreciate it. Thank you.
Coming up, Consumer Reports is out with its list of top vehicles of the year. Find out which ones made the cut. That's next. Now time for some of today's trending tickers. We're going to start here with home builder stocks. Shares of those companies on the rise amid reports of a home building proposal with the Trump administration. According to Bloomberg, Lennar and Taylor Morrison Home are among the firms working on a program to develop Trump homes to address the affordability crisis. One version of the plan includes investors renting out homes to tenants whose monthly payments would eventually be counted toward a down payment if they wish to purchase the home. Next up, Novo Nordisk shares sinking here as the Ozempic maker warns sales and profit growth will take a hit in part due to competition heating up. Company's sales outlook is also impacted by lower realized prices, including impacts related to the most favored nations agreement in the U.S. While Novo faces pricing headwinds in an increasingly competitive market, the company says it is encouraged by the early uptake from the U.S. launch of its Wegovy pill. And finally, take a look here at oil. Geopolitical risk intensifying as a U.S. fighter jet shoots an Iranian drone, the latest sign of escalating tensions between the two countries. The Trump administration also reportedly preparing to issue a general license allowing U.S. oil companies to begin drilling for fossil fuels in Venezuela. According to Bloomberg, the prospective license could be issued by the Treasury Department as early as this week. Well, Consumer Reports is out with its list of the top new cars for 2026, and there's a clear theme investors and consumers should pay attention to. For more, we're bringing in now Yahoo Finance senior autos reporter Praz Subramanian. So Praz, so every car on here, it looks like, is electrified in some way. What is that Sort of tell us about the market, where it is, and where you think it's headed, Praz.
So you see a lot of traditional normal cars, your Honda Civic, Ford Maverick, Ford F-150, the Grand Highlander. But yes, they all have the option. Some have gas powertrains, but they all have the option for a hybrid powertrain. And one of them on the list is a pure EV. That's a Tesla Model Y. So what's it telling us? It's telling us that Consumer Reports, which is some consider the gold standard for reviews. They buy all their cars, they test them on the road on their track. They get no money or compensation from any of the brands, and they said that in this day and age, hybrid power combination of efficiency, cost, and in some cases with these cars, the utility space makes a lot of sense. So for everyday buyers, it might make sense if you're driving a lot to have a hybrid powertrain.
What are a couple cars on that list? A few cars that kind of stood out to you.
So the cars are all pretty mainstream, right? But the cars that stuck out to me were number one, Toyota Grand Highlander. This was redesigned a couple years ago. It took the regular Highlander, made it bigger, more sort of substantial, more space. And a lot of Americans love this car because of the fact that it's got a lot of space, it's got a comfort. It's almost like a Lexus, and it has good power. The Ford Maverick, again, that car, you probably see that truck a lot. It's that compact truck that Ford makes. It's smaller than a Ranger, but you can get it with not only all-wheel drive, but also hybrid power. Get something like 40 miles per gallon. Really, really good numbers there for a pickup. And then, of course, the Tesla Model Y. Look, say what you will about Elon Musk and Tesla, but the Model Y is a great car, redesigned about a year and a half ago or so. Great feature set. You got access to Tesla Supercharger network. Makes it a compelling buy if you want an EV. You don't mind some of the Tesla blowback.
So let's say I'm a viewer right now. I'm looking for a new car. If I read this list, is the implication, all right, your default in 26 here, it should be a hybrid?
I think if it makes sense for you as a buyer, if you're doing a lot of commuting, then yeah, sure. But if you're not driving that much, it's not that important that you have to have a hybrid. Some people I know like to have big, bulky SUVs and drive to the train station, but I won't name names for there. But you don't necessarily need that. But for people who do a lot of driving, and let's say you're a parent, you got a job, you're driving around, you're a sales guy, it might make sense.
Switching gears, minivans, another trend you've been tracking closely. What is it? What's going on?
We saw some data, right? Minivans, they were sort of trending down for quite some time, right? They were big when you and I were kids, right?
Sure.
Dodge Caravans and whatnot.
Yeah.
But recently, in the last 3 to 4 years, the sales have been spiking back up. And last year, according to Edmunds, sales were up 21% for minivans, the highest of any category. So what's happening here, right? So you're having millennials who are getting older. They have more kids. They have things they want to transport. They want to go to Costco. What they're finding is that the SUVs are fun and big, but they're not that efficient. You can't fit as much stuff in there. Whereas a minivan, low load floor, huge cargo area, sliding doors, power sliding doors, captain's chairs if you want, 3-row seating. Perfect for kids and families and people that are just transporting stuff. A lot of gig workers like it for DoorDash and also for Uber. So it's got a lot of use cases, and I think that's where we're seeing why a renaissance of the minivan.
A renaissance. What are the brands kind of dominating there?
So right now you see the Pacifica. That was the top, believe it or not, Chrysler Pacifica. This is the only car Chrysler has, okay? It's their top selling vehicle, top selling minivan in America. And you have a lot of sort of the brand equity there from the Dodge days and Plymouth days, the Plymouth Voyager. Now it's considered a Chrysler Voyager. So there it is. Very exciting. I know you love that car so much.
Oh, yeah.
But also I think a newer one is the Kia Carnival. It's a bit more modern style.
What does modern mean in a minivan?
It looks more streamlined. It's got like lower roof line.
Anybody want to go like aggressive with their minivans?
Apparently, the Chrysler CEO said that millennial dads are getting attracted to these minivans because they're putting on like off-road tires and cargo racks and even in some cases overlanding tents to make it seem like a cool thing, and it's bringing in new buyers. Yeah. That's what the Chrysler CEO said.
All right, there it is. That's the trend to watch. Braz, thank you. Appreciate it. All right, let's get an update here on the market. The Dow climbing back from session lows as we head toward the closing bell. The tech-heavy NASDAQ still the worst performer on the day, off more than 1.5%. Despite blockbuster results from Palantir, concerns about AI software looms over the industry as Anthropic launched a new round of tools. Checking the metals, silver and gold gaining ground here, but they are still both well off recent highs after the massive rout at the end of last week. Also, a quick check at Bitcoin, the ripple effect into crypto stocks, Strategy, Coinbase, Robinhood, all extending recent declines. We'll wrap it up today's Market Domination. Don't go anywhere. We've got you covered with all the action following the closing bell. We're waiting on earnings from AMD and Chipotle in the next few minutes. We've got the numbers and earnings analysis.